Hey there, I'm James, you're watching Accounting Stuff, and in this video I'll explain what EBIT and EBITDA both mean, how you can calculate them, and why they're important. If you're one of my regular viewers, then you might have noticed that I'm sat on a different sofa, and that's because I've moved. Yep, I've been living in Vancouver for the last few years, but now I'm in Sydney, which is actually where I used to live before I lived in Vancouver. That's a fun fact for you. Anyways, let's jump right in. What do EBIT and EBITDA both mean? EBIT and EBITDA are two ways of measuring a business's profitability. They are both acronyms. EBIT stands for earnings before interest and taxes, and EBITDA is very similar. It stands for earnings before interest, taxes, depreciation, and amortisation. So where can you find EBIT and EBITDA on financial statements? They both live in the income statement. This is the financial statement which summarises a business's revenues and expenses over a period of time. Revenue less expenses is profit, and like I mentioned, EBIT and EBITDA are both measures of profitability. So how can we calculate EBIT? EBIT stands for earnings before interest and taxes. And when we say earnings, we mean profit. You can find a business's net profit on the bottom line of the income statement. So this is going to be our starting point for the calculation. Before means that we're going to add back. And what are we going to add back? Interest and tax. Interest expenses are the cost of borrowing money. It's a non-operating cost, so it sits below operating profit. And tax expenses are what the business reckons it owes to the local tax authority for this accounting period. So we can calculate EBIT, earnings before interest and taxes, by taking a business's net profit and adding back the interest and tax expenses. This is our formula, and we'll come back to it in the example. But how can we calculate EBITDA? It's a very similar process. EBITDA means earnings before interest, taxes, depreciation, and amortisation. So we start with net profit and add back interest and taxes, just like we did for EBIT, but this time we're going to go a step further by adding back depreciation and amortisation as well. Depreciation expenses are the cost of reducing the book value of tangible assets. Those are assets that you can touch. This is because of use, wear and tear, the passing of time, or obsolescence. And amortisation is very similar. It's the cost of reducing the book value of intangible assets, assets that you can't touch. So EBITDA, earnings before interest, taxes, depreciation, and amortisation, is equal to a business's net profit plus interest expenses and tax expenses plus any depreciation and amortisation incurred during the year. Time for an example. 𝐎𝖑 is a company that makes sandals, which can be paired with woolly socks for a sublime combination of comfort and style. Here's their income statement for the year ended 31st of December. How do we calculate 𝐎𝖑's EBIT, their earnings before interest and taxes? Well, we know that EBIT is equal to net profit plus interest expenses and tax expenses. During the year, 𝐎𝖑 made a net profit of $1.21 million. So if we add back their interest expense of $140,000 and their tax expense of $250,000, then 𝐎𝖑's EBIT is $1.6 million. Simples! But hold on a moment, there's an easier way. $1.6 million is exactly the same as 𝐎𝖑's operating profit. This is no coincidence because EBIT and operating profit are the same thing. Most of the time anyway. Now that we've done and dusted EBIT, how can we calculate 𝐎𝖑's EBITDA, their earnings before interest, taxes, depreciation, and amortisation? EBITDA is equal to net profit plus interest expenses plus tax expenses plus depreciation plus amortisation. 𝐻𝖏 made a net profit of $1.21 million, so we need to add back their interest expense of $140,000, their tax expense of $250,000, and on top of all of this, we add back their depreciation and amortisation of $1 million. That means that 𝐻𝖏 has an EBITDA of $2.6 million. Given that EBIT and operating profit are almost always the same, a shortcut to working this out would be to say that EBITDA is equal to operating profit plus depreciation and amortisation. 𝐻𝖏 has an operating profit of $1.6 million, so if we add back their depreciation and amortisation incurred for the year of $1 million, then we can see that their EBITDA is $2.6 million, the same as we had before. If you find it hard to remember these equations for EBIT and EBITDA, then you can support this channel by buying my profitability ratios cheat sheet. The link's in the description. But hold up. What if you want to work out EBITDA, but you can't find depreciation or amortisation in the income statement? This can happen from time to time. Depreciation might be wrapped up in cost of goods sold if it's linked to production of inventory. If that's the case, then there's no need to fret. Take a peek at the business's cash flow statement instead. If it's been prepared under the indirect method, which is very likely, then depreciation and amortisation can be found under cash flow from operating activities. They're both added back to net profit since they are non-cash expenses. Now we know what EBIT and EBITDA both stand for, what they mean, where to find them, and how to calculate them, that leaves just one more question. Why do we bother? Why can't we use net profit to measure profitability? The problem with net profit is that it's been influenced by indirect variables that sit outside of a business's core operations. For example, interest is the cost of borrowing money, which is determined by a business's capital structure. And tax, it varies by location. Maybe we want to compare companies that are based in two different states or countries. If we remove all these interest and tax expenses, then we're left with EBIT, which keeps the focus on the business's operating efficiency. EBITDA goes one step further. It ignores depreciation and amortisation, which are the costs of capital investments. If we strip them out as well, then you can get a feel for how much profit the business is able to make doing what it does, like selling sandals in the case of 𝐻𝖏. And since depreciation and amortisation are both non-cash expenses, EBITDA is also a quick way to estimate if a business can pay its debts when they fall due. Huge thanks to all my channel members for supporting Accounting Stuff. Your contributions are greatly appreciated. See you in the next one.